Episode 50. The first credit card in the US launched in 1950. It was called the Diners Club card, used initially only in restaurants, but expanding rapidly thereafter. The best athlete to wear the number 50 was David Robinson. After his NBA career, he in fact became quite active in the finance space. He co-launched the Admiral Capital Group in 2008, which was an investment firm focused on real estate and private equity. Beyond MD, episode 50, here we go! Hey everyone, thank you so much for joining me for the 50th episode of the Beyond MD podcast. Thank you for supporting me on this journey of learning, curiosity, this opportunity to connect with people across the country, including so many of my own colleagues. When I go back and look at it, all the work over the last 3 years, as gratifying as it was, as much as I learned, none of it really would be possible without your ongoing support. So for me, a big, sincere, heartfelt thank you for sticking with Beyond MD all this time. And truth be told, I think the podcast has to go on because as I learn more about finance, I realize how much more there is to cover. So the podcast continues. I'm really excited for it, and I hope you're going to stick with me. So for the 50th episode today, we will be talking about, on the surface, maybe not the most exciting topic, but it's that of insurance, and with an emphasis here on disability insurance. Now, the basics of disability insurance were covered in episode 2, so if you are a newbie to the topic and don't know much about it, I suggest you go back and listen to that episode. Today's episode, we will be doing a deeper dive into some of the more complicated aspects of this policy. But one thing I do want to make clear, disability insurance is the most important insurance policy you will sign up for during your professional career because it protects your greatest investment, and that is all the time that you put in to get to where you are today so that you can work, generate an income, live your best life, and care for your family. So we will talk about how much disability insurance should we consider, when should medical trainees consider getting started, and then we will do a deep dive into some of the more common riders with these policies. We will talk about residual disability, partial disability, why these are such important terms, and then that famous own occupation rider. It's often thrown around as a blanket like it applies to everyone, but that may not be the case. In fact, the information in this episode made me go back and look over my own policy. When I look at my policy, I have a few riders. I have the future income option, so that allows me to raise coverage without proving my health. I think that can be a good thing as sometimes expenses rise in life. I also have a cost of living adjustment rider, so if I am on a claim, then the payouts will tend to keep up with inflation, which I think can be a good thing given how expensive life is today. And then it turns out I do have an own occupation rider, so we will dive into this in detail. I'm a diagnostic radiologist, and the question is, do I and do others absolutely need this rider? Well, the answer is in this episode. So to help me today, Kristen Fazio is back on the podcast. Kristen is an insurance specialist with Professionals Insurance Centre based out of Markham, Ontario. Professionals Insurance Centre has been in the industry for more than 30 years. They help more than 1,500 professionals across Canada, including many doctors and many medical residents. Kristen lectures across the country, and as I've gotten to know her and her team over the years, I do enjoy her ability to explain and break down these topics, and also her practical approach to things. So without further delay, here's my interview with Kristen Fazio. All right, Kristen, welcome back to Beyond MD. It's really good to have you back a second time. And where's the pod find you today?
Thanks for having me back. Same place, just as last time, sitting in my office in Richmond Hill. Nothing much has changed on that front, which is nice.
Okay, except that you have a little boy now, right? Who's been keeping you busy, so you're back well rested from the family day long weekend?
Yep, that's exactly it. You hit it right on.
Okay, Kristen, so questions have come up since our last chat. We talked about a bit of disability, a bit of term life in the first episode, episode 2. And so now I thought we could do a bit of a deeper dive on both. And so first, maybe addressing disability insurance. The question I want to talk about right off is how much should we be getting? Because I will hear certain stats. Some people say you need to get 60% of your income. That should be covered. But then other people say, forget about that. Maybe focus on your key expenses and go from there. Then I have other people who tell me, you know what? It's the most important type of insurance you're going to get. Just go for as much as they will give you. Maybe you could just give us a bit of a roadmap on how much we should be striving for.
Yeah, it's a really interesting question because you have so much flexibility in how much you can get. It is kind of in your as a client, it's in your control of, do I get, like you said, the 60%, just my expenses, maximize it. What I find, and this is from experience from seeing people go through disability claims quite frequently, the more you have, the better. And what I don't think a lot of people understand is when you're looking at buying disability coverage, the insurance companies will only actually give you up to like 70% of your income on a good day, on the best amount. So even at that, you're already sort of not getting that full income protection. So you always want to get that maximum. And the reason why I say that is because you never really know when a disability is going to hit. You could be young in your career, it could be later in your career, but you always want to plan for that worst case scenario. And if it is something that happens to you young in your career and it does take you out for a year, 2 years, 3 years, that's going to have a huge impact on so many other things, not only your expenses, but your retirement planning, your children's education planning. And so the more that you can buy early on, the more of that cushion that you're providing yourself. And another thing that people don't really know too is insurance companies do what's called, and what we refer to as, reverse discrimination. So the more money you actually make, the less percentage of income you are getting protected. And the reason why that is because if you're making, $1 million a year and you're getting a $25,000 tax-free monthly benefit, they're looking at it saying, okay, you don't really need that much to live off of. And so we're not going to give you, 70% of your income. We're only going to give you 40% of your income or 50% of your income, because we still want that incentive gap, that driving force to make you want to return to work. And for those that make a higher income, they don't necessarily, again, need all of that. And that's why they start to claw it back a little bit. So always, in my opinion, adding on as much as you can, covering your expenses, projecting out that future of what this could cost me if I had an early disability, if I was out of work for a longer than expected period of time, will make it a lot easier, because when you get into those higher income years, you're not going to be able to buy as much. So adding it on, sort of securing yourself when you're younger, when you're growing, it makes a lot of sense for your future.
Is there an absolute amount that they will max out at? You mentioned, I think, a $25,000 benefit. Is that the max amount, or is it usually a percentage of your income that they will max out at?
So it's an interesting kind of combination of the two. The maximum on most disability policies is $25,000. That's equivalent to just shy of $1 million income. That doesn't mean that that's the maximum you can get, though, because what happens is you can actually apply for more by a secondary policy, at which point, yeah, they'll do exactly what you said. They will look at percentage of income and they will kind of put the two together. The maximum we've actually seen purchased is up to $30,000.
Maybe we can kind of pivot into the high earning professional who just says, listen, my expenses are high. I'm going to need a very large amount of coverage should something happen to me. So what are the options in play for somebody who has a high income, has high monthly expenses, and says, well, I may need a bit more disability insurance? What are their options? Do they have to go for a second policy? Is that even possible?
There's a few things that I would first off start to have them do is to look at where the expenses are coming from, because a lot of people forget that you can have two types of disability insurance. You can have personal insurance and business insurance, your business overhead expenses. And sometimes people lump in their monthly needs as their personal mortgage or their company mortgage, and they kind of put all of it into one. And so if we separate the two, you can actually get quite a substantial amount of coverage, more than you expect. So for example, you can get up to $50,000 on business overhead. So covering things like staff, covering things like utilities, or if you have multiple locations, perhaps multiple rents, multiple mortgages, that sort of idea. And so that will help benefit and take off the weight of carrying so much personal disability. But if you still need more personal disability, that's where we say, okay, perhaps we've maxed out that $25,000 policy. We can apply for a secondary policy. But I also will have people start to look at using critical illness as a secondary support. Because a lot of the time when you're getting into that higher income earning years, you're also older, and at which point you're more likely to have a critical illness. So we can look at saying, okay, perhaps the maximum I can get is $25,000 a month, but I might buy a $250,000 critical illness policy, which will pay out in 30 days. And that will substitute and supplement with my disability to sort of give me that extra cash flow on a monthly basis. So you're right to a degree, you will cap out, you will get to a point, but you can be really creative in what we're using to help build up that protection from other assets in other areas.
Okay, that makes sense. Now, what about medical trainees? When should they start to think about getting disability insurance, and then how much can they go for?
This is such a great question because I am in the thick of it right now. So a lot of my clients are actually medical students. transitioning to residency and residence. We definitely service, those that are practicing, but the beginning of that relationship that we foster is with somebody who's just starting out into their career, because that's when it starts to trigger things like, oh my goodness, I'm not a student anymore. I'm not a residency employee anymore. Like, what am I doing? How am I protecting myself? So 100%, the earlier you buy this, the easier it is. And not only from the position of, when you think of disability insurance, it's the most difficult insurance you can buy. And the reason is because insurance companies are looking at you in a snapshot of your life and they're saying, okay, for the next 35 years, what is the risk that this person might get hurt, might get ill, might have to take time off work? That is a huge, huge risk that they're taking on. So they look at things like age, sex, occupation, income, your health history, family health history, your travel status, your hobbies, what sports do you play? And they use all of that to sort of say, okay, is this person a good candidate? Yes or no? And so the younger you are, it's probably the healthiest you're ever going to be, likely. And so it makes it a lot easier to buy things. But what a lot of people also don't realize is, as a student and resident, there is massive amounts of savings that you can get. So there are, situations where you get 25% discounts for the rest of your career by buying it as a resident or a medical student. You get a year free, so you don't have to pay for it for, example, PGY1. You can just skip that year and then you're not paying for it until PGY2. And the kicker, the best for me, is that when you're buying it as a trainee, you don't have to answer any medical questions. There are 5 questions that you have to answer to get what you probably went through, was a 30-page application, blood and urine samples, much detail. They get to avoid all of that. And so even just taking out the risk aspect of, like, could you get hurt? The apples to apples of waiting versus not waiting, it's astronomical how much you save and how much easier the process is by doing it as a trainee.
Okay, perfect. And I think on our initial episode, you mentioned one useful rider in that situation, I guess the future income option.
Yes.
Where as their income goes up, then they can get more coverage without often having to prove their health. Is that correct?
Precisely. And that's exactly why the idea of getting it as a medical student, it's, I always joke with my clients, they think like, Kristen, I don't make money. I have more debt than I have income. Like, why am I buying this? And it's true from that perspective. There isn't a huge need for coverage right now, but what you're doing is you're getting your foot in the door. You're buying this exceptional policy, the best on the market, best price, easiest way, knowing now that you can increase it as you need it, as even throughout residency into practice. All of that growth potential is included in that one product.
So some medical trainees may ask, well, should I be getting it in medical school? I sometimes, in the back of my mind, I find that hard to justify, because medical students typically won't have an income until the very end of clerkship, depending on which school they go to. But in residency, they do. So do you see more people saying, go for it in med school, or maybe wait till first day of residency? What do you advocate here?
I advocate heavily for those that are in 4th year to look at purchasing it so that it lines up with a residency start. So that's how you're securing those discounts and all that, free premium and all those types of things, but you're pushing it as far as you possibly can so that it's lining up well with actually generating income, actually having the risk of you're at work now and you're seeing that need for disability. But I agree, nothing earlier than that really makes a lot of sense. My only kind of caveat to that would be if somebody's very concerned about their health, if you've had a diagnosis, if there's something major in your health history that you are very aware of as being a concern for you, then perhaps it does make sense to buy it while you are still healthy, or while things are steady or stable in any sort of diagnosis that you have. So that's the only outside of it that I would say if someone's worried about health. Otherwise, waiting, like you said, till that end of 4th year, starting residency is a perfect time.
So critical illness insurance, disability insurance can be expensive. And we know that many people at some point in their life may have to deal with a disability. So we know why it's expensive. But my understanding is we can save in certain ways. And you talked about one with a medical trainee signing up younger and getting a good policy, probably saving some dollars along the way. And I also found out, and this is thank you to, I'll give a shout out to Grant Maxted, who's one of our physicians in our physician community. He told me that you can inquire if you have an independent policy and maybe pay the premiums annually, save a bit on your policy. So I inquired, and I was able to save about 5% a year. Not huge, but something. So does this apply to everybody who has an independent policy, or is it kind of more on a carrier by carrier basis?
That's a really good question. It's Basically all insurance companies at this point will offer a discount for an annual policy.
Okay.
The reason being they're foregoing any of the sort of admin of a PAD, like of the pre-authorized. It's not a lot of transactional monthly things. So my rule of thumb, and that's something where I always find that the help of an advisor really comes in. That's something I always talk about my clients. So most of the time when you're a medical student, resident buying this, we do monthly because it's just easier sort of in that transition period. When they started to practice, that's when I'll say, okay, it makes sense if you want to go annual. The other thing too is, again, as an advisor, my job is to sort of always keep my eye out of what types of discounts we can get. The more discounts, the better. So sometimes if you have like teaching privileges at certain hospitals, or if you're at a hospital with a large number of physicians who enrolled, for example, with an RBC disability policy, they will offer you discounts, if there's more than 3 people at that hospital. So you might get a 15% discount. And so that's, for me, if you're not applying as a student and you're applying as a practicing physician, I will always go and find the discounts first. And then I will say, okay, here's what I found. We can get 15%, we can get X, Y, and Z, and then make that a little bit easier, because you are right. Disability, especially for females, is very, very, very needed, but also expensive at the same time.
I want to get into a few more riders, and I want to revisit the own occupation rider, because I was at a talk, I was giving a kind of crash finance course for the radiology residents at Queen's. This was recently at their half day, and we brought up disability insurance. We started talking about riders, especially own occupation, and the group was very divided. And so maybe just remind us, Kristen, what exactly does this rider entail, and who, in your opinion, usually benefits from it?
Okay, so the first thing I'm gonna say is that the beauty of own occupation is it's just an extra benefit.
Yep.
If you choose not to have it, it is not a deal breaker. It does not completely affect your ability to claim. A lot of people get confused with what own occupation means and what it does for a policy. So the reason why it's an addition, that it's a rider, is because it gives you that flexibility to line it up with what your career looks like. So own occupation in its simplest form, it means that if you're unable to perform the essential duties of your job as a physician, and you are choosing to retrain in a completely different field, then your disability benefit is going to continue to pay you at the maximum amount, in addition to any new income that you are making in your new job. So I always use the example of, you have a high-level surgeon who can no longer perform a surgery due to tremor, let's say, in their wrists, in their hands. And because of that, now they're like, okay, I'm early in my career. I don't want to sit around and do nothing. I want to do something with my life. So they become a real estate agent. Well, the income that they generate as a real estate agent is going to be paid in addition to, let's say, their $15,000 a month disability policy that they have. So both will now pay you together. The caveat to this definition of where people sort of become for or against it is that the new job cannot have any of the same duties or qualifications as your old job.
Okay.
And so when you look at something like real estate, there is no need for this hand dexterity and mobility. You could do it with a tremor or not. And so there's really no correlation to the job duties of a physician and a real estate agent. Where it starts to get gray, and where I usually recommend that people don't need it, is something like a family physician, a psychiatrist, where their duties are much more of like a traditional, like a desk-based style of practice, where they are, meeting with patients, light manipulation, they're having conversations, they're taking notes. It's going to be very difficult for them to find another job that doesn't have any of those duties.
Okay.
And so that's where the own occupation, although they might have it on their policy, the insurance company might say, well, no, unfortunately, we're not paying you under own occupation because the duties are quite similar between your two jobs.
Okay, that makes sense.
If you don't have...
Yeah, no, go ahead. I interrupted you there.
I was going to say, if you don't have own occupation, what people forget is the policy is still very favorable, because what it's going to do is it's going to say, and again, I think we'll touch on this as well, if you have one of the more robust contracts, so it always depends. So check your contract before you listen to everything I say. But most of these contracts will say, okay, if you do transition to a new job and you don't have own occupation, but your new job is generating less income still than you were making in your previous role, it's going to top you up. It's going to still give you that difference, so that your lifestyle and your income and all of that you've based your career off of and based your future off of is still status quo. So it's not because you start this new job now your disability cuts you off and you have nothing left because you don't have own occupation. Yeah. It's just not going to be paying you more than you were making before you were disabled.
Okay, gotcha. So now, selfish question for myself, the diagnostic radiologist, I spend 90% of my time sitting at a desk looking at pictures, 10% or less doing procedures. So for me, if I was to get another job, very likely it would be a desk job. So what I'm getting here is that people who spend the majority of their time maybe in front of a computer at a desk may not benefit from the own occupation rider. Is that correct?
That's correct.
Yeah.
And that's where I say a lot of the time as, residents and students who are buying this plan, if they don't know exactly what their career is going to look like, if they're going family med, psychiatry, sure, let's not get ONOC. If you're concerned about what that day-to-day is going to look like, there's no harm in having own occupation because it's very easy to remove things. It's much harder to add features.
Mm-hmm.
And so for someone like yourself, when you get to a point where in your career and you're like, wait, when I look at my day-to-day, it's going to be very hard to find a job that doesn't use any of this. I'm going to get rid of own occupation.
Right.
And it's very, very simple to remove it. And that's the route I normally take. But you're spot on. For someone like yourself, it doesn't play a huge role because what the insurance company is going to do is they're going to look at what the day before you were disabled, what were your duties? And if 90% of that was at a desk, then your new job can't have a desk component to it. And in reality, if you are retraining into a new field, it's going to be something that's probably more desk-based. It's not like you're going to be adding more labor and more if you have a disability now. And so the likelihood is you're either not going to retrain and you're just going to stay disabled, or you're going to retrain into something different, but not be able to use it on occupation.
I'm so glad we're talking about this because I can tell you own occupation is just kind of thrown around as one of those terms. Like people will say, okay, you signed up for DI. Is it own occupation? Like when I signed up for my policy, I told my dad, hey, I've got disability. This was back in 2017. He said, does it have an own occupation rider? I was just like, what? No, I don't think it does, but it's just thrown around like one must have that. So this is really, really helpful for all of us. Last question on this. So real estate agents, look, let's say you can't practice your area of surgery. You become a real estate agent. Some real estate agents make a lot of money. So if the income from that new job is more than you were making in medicine, will the policy still pay out?
Yes, that's the key difference. So your policy will, let's say you're making $500,000 at the time of your disability and you are now making $1.5 million as a real estate agent, your disability is still paying you off of a $500,000 income in addition to your new
Okay, very interesting.
And the idea behind it is that, like, if you think about it, if something happened to you very early on in your career, you wouldn't have really reached your income potential. Mm-hmm. So they want to be able to capture into that and say, we understand you've put a lot of time and energy and dedication into this career that was cut very short. Yep. And another job might not give you that same level of income support. So we're not even going to look at it. We're just going to ignore your new job and continue paying you off of your old one.
Very interesting. So any other riders that we need to be aware about? Because in my reading, I came across terms like partial and residual disability. And when I went through them myself, I found them a little bit confusing. Is this something that's worth knowing about?
Definitely, because I think for me, again, seeing firsthand, working with physicians quite often, these are two of the most important definitions that you have on a disability contract. Mm-hmm. And it depends on what insurance company you have purchased your policy with. So for example, certain companies like an RBC contract, they have them embedded in their contract. So it's not a rider, it's not an additional feature. You get both partial and residual. Okay. There are other companies where you have to choose partial or residual, or you're paying even extra to try and get both. And so you always want to go with the route of a plan that has partial and residual included. And one of the main reasons is because of the way that those definitions work. My opinion of disability is you want to be able to claim the easiest way without any questions, without anybody kind of coming at you and saying, oh, well, this doesn't count or this doesn't count. You want flexibility. You want to know that if I am hurt and I cannot work, I'm going to get paid. These two riders, or these two embedded features, depending on your contract, are the key to getting that flexibility. So I can explain to them and they'll be very simple. And I promise you'll actually understand them a bit more. So how I kind of consider them and explain them to people is when you have a partial disability, think about it as a loss of time. So you are working part-time. So let's use a stress-related condition where, something's going on and you need to take a step back where you can't be in the office. And I know this is not a traditional physician schedule, but just bear with me for the explanation. You're working Monday to Friday, 9 to 5. And because of this stress now, you're only able to go into the office 2 days a week. Mm-hmm. What the insurance company is going to do is pay you 50% of your benefit to support you during the time that you're not able to be back in the office full time. So you might be generating more than 50% in those 2 days. It doesn't matter, but you're off work for 50% of your day-to-day activity, and therefore they're going to pay you 50% of that time.
Okay.
Residual disability is a loss of income. So again, same example, it's stress related. To the average person, like you were back to work Monday to Friday, 9 to 5, you were there every day. But instead of being able to see 10 patients a day, you're only able to see 2 patients a day because you need to take the time off in between to rest, recover. And that is a massive impact to your income. And so from that perspective, the insurance company is going to do a replacement percentage. So if you're, making 40%, they're going to top you up to that 80% income protection. And so you're not going to be losing income, even though technically you're back at work full time. They're able to say, okay, you're not generating as much income as you were before. We're going to support you in that. And what the careful part is you have to be careful because even when you compare like association style plans, they will have partial and residual, but they will word it to say you have to have a loss of time and income. Okay. Which means now you're going to limit how you're able to claim. In a very robust contract, you're looking at a loss of time or income. So all we need to demonstrate as your advisor, it's my job to say, okay, insurance company, this is what's going on. My client has been out of work, unable to see patients at the full capacity and is losing 40% of their income. We need to top them up. And that will give them access to say, yes, you fall under a residual claim. Maybe it's a part-time. Yes, you fall under a residual claim. Okay. Maybe you're not working at all. That's where you fall under total. Okay. But without those two features and you're only under a total claim, that means that if you're not working, that's the only time you're going to get paid. If you try any sort of return to work, part-time work, they're not going to have any coverage for you.
That's so helpful. Now, going on to later in life, we may reach a stage where we say, okay, should something happen to us, maybe we can kind of fund this time off ourselves. We've kind of reached a certain level of financial independence where we can make this happen. So then that begs the question, when do we start to think about maybe canceling some of these policies? Maybe it's as simple as when do you reach financial independence? And that could be different depending on the person. But can you give us some just basic guidelines here?
Yeah, it's such a tricky topic because I always think when I, again, handle so many claims that there are so many people that I would say, I would never cancel it. But that is because I'm a very risk adverse person and I really appreciate having that protection plan. But kind of to your point too, when you think about financial independence, I try and look at things like, having children and having that future. Once you feel like, if something happened to me tomorrow, I would be able to support no questions asked from now until the day that I die at 90, let's say, I would be able to support my entire lifestyle, my family, everything, no questions asked. Then you might want to say, okay, do I really need this product? Most of the time I find when you ask those hard questions, most people are like, ugh, I don't know if I want to. I don't know if I would want to dig into that money that I wanted to leave as a legacy to my children or dig into that retirement savings early. I would rather have the $15,000 a month paid for by somebody else. And so it really comes down to sort of personal preference at that point. One of the key things to also consider too, and I find this is what happens first, this is more of that trigger. When you have a disability policy specifically, when you have to be working 30 hours a week to justify working full time to be able to claim under a disability policy. Okay. So what I find is a lot of my clients in their early 60s, they start to wind down. They're like, I'm not really working 30 hours. I'm kind of taking it slower. Maybe I'm only working 15 hours a week. Maybe that's the time where we say, okay, your disability isn't valuable anymore because you're actually not even satisfying the definitions of being able to carry this policy. So usually I find before it's financial independence, it's more of that career shift of saying, okay, I don't really need that income protection. I'm not working full time. I'm winding down. I'm starting that retirement sort of practice. And that makes a lot of sense to do.
That sounds practical. So let's shift gears maybe to term life insurance. And I want to start off by discussing how much should we get? Kristen, I've talked to a lot of people and some people say, well, you're funding it through the corporation. It's a drop in the bucket. Who cares? Go for as much as you can, 10 times your income minimum. And for me, I always like to take a bit more of a structured and objective approach. So maybe you can give us a bit of a roadmap on if we're opting for term life, how much should we be going for? What factors do we need to take into account?
It's a good question. It's such a weird product, right? Because you're just selling the unknown. You're selling this guesstimate. Like it's very difficult. You're not buying a thing, right? And so it's very hard to pinpoint that number. And that number is different for everybody. A part of that factor is your risk aversion, right? Like if you're very risk averse and you're very nervous, you're going to buy a lot more insurance than somebody who's like, you know what? Let's play the odds. Let's sort of build up that cash flow on my own. But one of the big things I always say to people is, obviously, the younger you are, the more coverage you're going to need. So when you're starting off your term insurance journey, ironically, nowadays, I don't think I've sold less than $1 million of coverage because that's just sort of the cost of life right now, even without having children or having, a partner. If you buy your first home, your mortgage is likely in and around $1 million or right around that point, right? So when you're starting out younger, you kind of need to start building that. And the likelihood is as your career progresses, your lifestyle progresses, you're going to need more. So it's always nice to sort of cushion yourself when you're younger to get much more term insurance and sort of make sure that it's robust right off the bat. But when you're thinking about it for somebody perhaps mid-career, where they have some of that financial dependence, where they have sort of that, family life that they're protecting as well, what I kind of look at is this kind of idea of using capital. And so funny enough, maybe it sounds like I love disability because I do, but I kind of tie it back to disability. And I think to myself, okay, if you need $15,000 a month to support yourself if you were disabled, I kind of transition that into a life insurance need as well. You likely will need $15,000 to support your family unit without you there. And so what we want to do is we want to project out that number and kind of get that pool of money that to say, okay, when we draw down that $15,000 a month to keep our lifestyle as is, this pool is still going to be there to support whoever I'm leaving behind until they no longer need that support. And so it's kind of makes it a little bit easier to look at, to sort of think out, not so much like, take your income times 1,000, divide by 2. It's not so much of a math equation as much as it is looking at your needs and looking at things like, what are my day-to-day expenses right now? Like your utilities, your mortgage payments, any debt that you're carrying that you have to pay off that you'd be leaving in your absence to somebody else to manage. Talking about, yes, replacing your income, but what does your income do for you? It saves for retirement. It hits those future financial goals. What does that look like without your income? Children, like what does their education system look like? Do you want to be supporting them through that? And so that's where we sort of get that monthly figure of 15,000, 10,000, whatever that number is, and then can project out. Again, being younger, you're going to need more. And that can kind of dwindle off as you get older. When children aren't as dependent, you're financially more dependent for yourselves. And you can start looking at perhaps permanent insurance where you're leaving more of that legacy framing kind of idea and drifting away from that term. One thing that I always think is really important too when you're looking at term, a lot of people will say, okay, but I already have a house that I have paid and I have RSPs that I have saved and I have TFSAs and I have all of this. When you are looking at that to reduce the amount of insurance that you need, start by looking at what is liquid. Because what you want to be doing is to say, I have $500,000 in my RSPs, I don't need life insurance. You don't want your partner or your family to have to get the tax bill and the burden of pulling out an RSP to support their lifestyle in the immediate. So as much as those do support you, we want to look at just the liquid things like TFSAs, like things that are in cash. We don't want your family to have to sell the house to continue their lifestyle. We want to maintain status quo. So when you're looking at what assets you have to reduce the amount of life insurance that you need, look at it from the perspective of cash, liquid, usable assets that you could technically liquidate and use for your lifestyle, not everything.
Okay. That sounds really practical. So we kind of went over different types of debt, mortgage debt, non-mortgage debt, how much you would need to spend a month, project that out over time, kids' education, and then liquid assets. I do like the emphasis on liquid assets because, if you empty out an RRSP, there's going to be a pretty significant tax bill there. So spousal income, that's one thing I didn't ask you about for disability. I guess it can come into this conversation on term life as well. But if we have a spouse who's earning a healthy income, I'm assuming we take that into account at some point, right? For both life and disability. Just speak to us about that a bit.
Most definitely. Because I think too, again, it depends on the role that income plays. If you are the breadwinner of a household, then we are always maximizing out your disability protection. And even at that, even when you look at somebody who, let's say you are equal earners within a household, from a disability perspective and a life perspective, imagine the situation where you can no longer work. What if your spouse wants to take some time off to take care of you? What if it's, people forget with a disability, like you are still living, you still have to retire, you still have to live out that life that you have ahead of you. And it's a burden to a degree on your family because your partner's not going to want to go back to work if something major's happened to you and they want to be there to support you. So as much as we are factoring in their income, we also want to be able to say, okay, now we've added a burden to them. We're no longer here and they can't go back to work because we have young kids and they want to slowly transition into having some sort of, daycare or support for those children, after school care. It's not as smooth as just saying, okay, well, great. That person's gone back to life. And so having that protection include their income is important to make sure that obviously you're not super over-insuring yourself, but to also give them a bit of breathing room to think that they are not going to go back to life the exact same way after, day 2 of what happened, whether it be a disability or a life incident.
Right. So I played around with an online calculator recently. And so in the last year, Kristen, so I did have to, I elected to increase my term life insurance because of a real estate investment or two. And so I said, well, I've taken on more mortgage debt. So let me just increase this because should something happen to me, I want to make sure everything is covered. And I played around on the mortgage calculator and I was pleasantly surprised to see that I was what was projected for me, what was advised for me was pretty close to what I had. But then one thing I didn't see in that calculator was inflation. Like I assume these calculators take that into account, but I think this is just something that's on our mind all the time right now. And so I guess when we're projecting things out, whether it's through a calculator, like do these take into account inflation and maybe higher than average or not?
Yeah, you're right. The most calculators, like do-it-yourself style planning, will not take into account inflation. As an advisor, I do factor in about 2.5 to 3% inflation.
Okay.
And I know that's sort of more of a ballpark, but there's going to be good years and bad years, as we've seen right now with inflation. And so there is a value in incorporating that in. Again, when you are looking at insurance, I always base it off of worst case scenario. Right? We're hoping for the best case where you never need these products. It's just one of those things that we don't have to worry about. But we want to look at it if something happened tomorrow. Like, what is that lifestyle? And so when you have a young family and you've got 30 years, you don't know what will happen with inflation. And so you're right, you have to build that extra nest egg in. And that's why when we do the whole idea of monthly planning, where you're kind of lining up how much you need a month with your term insurance, the idea is you're going to take that term policy when it gets paid out. So let's say you had $1 million term product. It pays out, it's tax-free. You're going to invest that and hopefully use that invested amount to sort of pay off your monthly needs. So that's the whole game point of trying to get that pool of money to sort of sit there in a way to protect you. And then obviously later on in life and retirement and stuff, you can start to wind it down. But in that intermediate time, that's why it's almost, it's never a bad thing to be overinsured. It's worse to be underinsured when you're not prepared for the inflation and the things that will come. But getting that dollar amount to a point where when it's invested and you draw from it, you're going to be comfortable whether you're at a 2% inflation or a 6% inflation or whatever that might look like. You have that sort of security in that pool of invested money.
This might be a dumb question, but just you can cut me off if this is inappropriate. But let's say you take 10 physicians off the street. What percentage are underinsured versus overinsured versus adequately insured? I'm just curious on your experience on this.
It's a hard question. It's a hard question because I would say that we service over 1,500 physicians across Canada and all of them are very much adequately insured, but that's our job. So we know that they're insured.
Yeah, I would say,
to be honest, I will say when new clients come to me, I find that depending on the advice that they previously had, they are either underinsured or overinsured. It's very rare that I get a new client that is adequately insured. So I think that sometimes, we fall into the whole idea for me of getting life insurance disability is to meet a need. We don't need to be over or under or anything along those lines. We want to meet that need, and to be a little bit over is fine. But I've had clients come with an aggressive amount of life insurance. It's just it doesn't even add up to a number. I don't know how we get to that number. So if it makes sense to you as a client, that's our job, is to kind of interview you and get enough information to say, okay, this is the number we're thinking of, and this is how we got there. And that way we can decide whether you want that amount or not. That's great. But at least the number makes sense to your goals, your lifestyle, your future. But I would say there's quite a handful that are on the far scales of over and underinsured.
Kristen, that was super helpful. We covered a lot of ground. Is there anything else you'd like to share that we didn't touch on? I'd like to give you that chance.
No, I think we had a really good discussion this time yet. And I think it's so nice that we could come back and sort of elaborate more on some of the more difficult insurance topics. And I think we've kind of nailed it on the head this time.
Awesome. As always, Kristen, really appreciate your time. Keep up the great work and hope to connect in the future. Okay.
Sounds good. Thanks.
So you'll notice in my interview with Kristen, I reacted to own occupation as if I did not have that rider in my policy. But when I went back and read my policy, I do have that rider. So it's something I'm going to give further thought to as to, do I truly need it? And how is my career going to evolve with time? Anyways, guys, thank you as always for your support. You know the drill. My social media links, email are in the show notes. And I will see you actually next week. We're going to be releasing an episode on a physician's locuming experiences. So please tune in for that. Until next time, stay well, stay savvy.